Hello everyone, I am Chintan Lakhani, Director Large Corporate Ratings at Brickwork Ratings. Hope everyone is safe and sound. Today, through this podcast, I will be sharing Brickwork Ratings views on the housing finance companies. HFCs have grown at a healthy pace in the past few years, supported by growing demand owing to economic and social development, the government's consistent focus on promoting housing, and a supportive regulatory environment encouraging growth. Following the NBFC crisis of September 2018, the lender investor community became wary of lending to non banks, especially to standalone entities with exposure to wholesale lending or wherein the asset liability mismatch was relatively high with a limited liquidity cushion, or NBFCs having relatively small AUMs and or had a portfolio with limited vintage. This resulted in investors losing confidence and funding lines fizzling out from capital markets and lending institutions, thus resulting in reduced AUM growth FY19 onwards. Over the past few years, small and mid-sized HFCs have been much more impacted. This situation further deteriorated in FY20 as at least two large HFCs virtually stopped fresh loan disbursements due to their own organizational specific issues. The slowdown in housing sales further impacted demand for credit during the year, keeping loan growth for HFCs muted. While, while sentiments and business environment were widely expected to improve in FY21, the year saw a crisis in the form of the COVID 19 pandemic. With a complete washout of Q1 for all sectors owing to strict countrywide lockdown and a severe impact on the lives and livelihoods of people, demand and hence the home sales reduced drastically. However, some measures by the government in H2 FY21, like reduction in stamp duty in Maharashtra, historically low interest rates, and stagnant home prices, helped garner some demand in this space. However, the business has not been distributed evenly among players, with large HFCs cornering the majority of fresh disbursements and small and mid-sized HFCs struggling in terms of business growth. While disbursement for HDFC Limited and LIC Housing Finance Limited grew year on year by 8% and 18% respectively in FY21, there was either a degrowth or subdued growth for small and mid-sized HFCs, except those focused on affordable housing like Canfin Homes, Repco Home Finance, GIC Home Finance, and others. While small and mid-sized HFCs struggled in terms of business growth, HFCs that focused on affordable housing space continued to see healthy growth in FY21 and even better than the large HFCs. Disbursements by Aadhar Housing Finance and Vastu Housing Finance have seen a year-on-year growth of 11% and 29% respectively in FY21. Affordable housing segment has uplifted the sector as the pandemic significantly impressed upon the value of homes due to increased approach of work from home culture, reflecting the dire need of alternate houses. The need for safer and bigger spaces could actually result in increased demand for residential real estate and is expected to see an increased home buying from the final or the end user rather than the investors, especially in the affordable segment. A podcast covering a similar theme in the real estate sector has already been released a few weeks back by Brickwork Ratings. The stress across the segment can be clearly witnessed in the form of rising non-performing assets, especially in FY20 and FY21, owing to the outbreak of the pandemic. The nation faced strict lockdowns, leading to a complete shutdown of business activities, resulting in severe economic disruptions impacting cash flow of borrowers. The second COVID wave impacted not just the disbursements in Q1 FY22, but also the overall collections, thus delaying the much anticipated chances of recovery. The slippages in the near term are expected to come from mid and small HFCs as they have a larger chunk of self-employed and low to middle income group borrowers, which thus reduces the ability of these HFCs to absorb shocks in their portfolio. The pandemic has further aggravated the stress in this space on the back of economic slowdown and liquidity issues. Brickwork Ratings expects the macroeconomic environment to remain strong, supported by stable and improved demand in an era of low interest rates ever witnessed in India. While pent-up demand has been helping the sector remain afloat amidst the pandemic, the recovery in the economic activities will provide further fillip to the revival of asset quality of the home loans in the long term. It is expected that the affordable housing segment will grow much stronger and lead the sector's recovery going forward. The demand from home buyers is picking up, indicating the potential growth across the various categories of home financers. One of the major challenges facing the sector would be to tide over the much anticipated third wave and any consequent lockdowns that may be imposed. Brickwork Ratings expects normalcy or near normalcy situation to be around Q4 FY22 or Q1 FY23, owing to speedy vaccination drives, even as approvals to newer vaccines are awaited, which in turn would result in opening up the economic activity to the fullest. Thank you.